All right, let me show you something wild. The S&P closed basically flat on Thursday, down 0.01%. But don't let that number fool you. Under the surface, this was one of the most divided trading days we've seen in months. Here's what I mean. Same day, same market. Micron, up 16% after reporting earnings that absolutely crushed it. Caterpillar, up 6%, hitting a brand new all-time high. The Semiconductor index rallied nearly 4%. Meanwhile, Apple dropped 6%, its worst day in over 2 years. The Nasdaq logged its fourth straight decline, and the S&P itself has now fallen for 4 consecutive sessions. So which market are we in? The answer is both. And that's exactly what makes Friday so tricky to navigate. If you're new here, hit subscribe. Free watch list down in the description. All right, let's start with the chart that matters most. The S&P 500, 4 red candles in a row, each one small, each one grinding lower. The index closed at 7,357. Now look at the structure here. Price has broken below the short-term trend line, that orange line that's been supporting this rally for weeks. It's no longer supporting. But, and this is important, we're still holding above the midterm trend line around 7,300. So the way I read it, short-term momentum has shifted, but the intermediate trend hasn't broken yet. That's your line in the sand. Lose 7,300 on the daily chart, and the conversation gets a lot more serious. The 1-hour picture tells the same story even more clearly. You can see the cascade from 7,560 down to 7,357 over the past few sessions. All 3 trend lines are now stacked above price, short, mid, and long. That's bearish alignment. We're trading in a tight range between 7,340 and 7,360 right now, basically waiting for the next catalyst to break us one direction or the other. That catalyst came in the form of PCE inflation data. Core PCE came in at 3.4% year over year, the highest reading since October 2023. The market was expecting 3.4, so it wasn't a surprise on the surface. But the trend is what matters here. Inflation was supposed to be cooling off by now. Instead, it's stuck, maybe even re-accelerating slightly. The market is now pricing in roughly a 63% chance of another rate hike by September. That's real. That matters. Now, on to the bright side, because there actually was one. Micron. This stock delivered one of the most impressive earnings reports I've seen this year. Revenue, $414 billion, beat estimates by a massive margin. Margins, 85%. Guidance? They raised it by another 20% on top of that. The stock ripped 16% higher on volume of 83 million shares. That's institutional money pouring in, not retail FOMO. Look at the daily chart. That green candle is enormous. Price is now sitting well above all 3 trend lines. And honestly, the deviation from the short-term line is getting stretched. That tells you the move was violent, not gradual. The 1-hour chart shows the whole story in motion. Opened around 1,240, spiked to 1,250 intraday, settled at 1,214. Pure buying pressure from the open to the close. What Micron's report confirms is something we've been talking about. The AI infrastructure build-out is not slowing down. If anything, it's accelerating. And that's why the entire semiconductor complex caught a bid on Thursday, lifting the Philly Semi Index almost 4%. But then there's Apple, down 6% on the day. Why? Because they announced their biggest price hike in 40 years. MacBooks up 16 to 25%, iPads up 17 to 20%. Tim Cook himself said he hasn't seen component costs like this in 4 decades. Think about what that means. The same chip shortage that's making Micron rich is now forcing Apple to raise prices on consumers. One company's margin expansion is another company's cost crisis. That's the kind of market divergence we're seeing right now. And speaking of divergence, let's talk about Caterpillar. Closed at 1,257 on Thursday, up 6%. Intraday high? 1,081. A brand new all-time high. The chart shows a clean breakout above the $1,000 consolidation zone that held for most of June. Industrial stocks are catching bids while tech stocks are getting sold. Money is rotating from growth at any price to things that actually make money right now. CAT is the poster child for that trade. So where does that leave us for Friday? No major economic data on the calendar. That means position rebalancing into month-end and quarter-end will likely drive the action. After a day as split as Thursday was, markets tend to seek some resolution. Either the rotation continues and industrials keep running, or dip buyers step in for tech and we get a relief bounce. My read? Watch the S&P 7,300 level closely. Hold it, and this is just a healthy pullback within a bull market. Break it, and we're looking at a deeper correction towards 7,200 or lower. Bottom line, this is not a simple market anymore. Pick your spots, manage risk, and don't assume yesterday's winners will be today's winners. You know the drill. Subscribe, hit the bell, watch list in the description. Good luck out there.